Analysts at Parthian Securities Partners say they expect the Nigerian equities market to sustain its upward momentum on the back of sustained investor confidence, strong sectoral performance, and positive market sentiment. Olufunmilola Adebowale, head of research at Parthian Partners, joins me for a market review. Funmilola, thank you so much. Pleasure to have you.
Thank you for having me
with us. Just looking at market performance last week, the market did have a good outing last week. The Osho index ended up 0.09%. Many of the, or all indicators, except for the NGX Premium and Lotus 2 indices, finished in the green. So we're seeing this momentum being sustained by investors. So talk to us in terms of the strength of that momentum for this week. Market, I believe, is just closed a few minutes ago. What will sustain this momentum?
Yeah, thank you, Esther. So I would like to mention that we've seen the market performance has been largely bullish in the last couple of weeks, and that was on the back of the impressive Q1 numbers we saw. So investors are reacting positively to this. And apart from that, we've also seen that some companies are still come deep, a number of them, right, and investors are taking position ahead of the qualification date, especially for the ones that have impressive dividend payment. So all these factors are actually supporting this bullish run in the market. Last week, like you mentioned, the market gained 0.9%, and we saw the 5 indices, sub-indices close in the green. So we expect this positive performance to continue, though we expect the performance this week to be mixed to positive. Number one, for some stocks that are really rallied, we're likely to see some level of profit taking. So investors are likely to do that, which will impact the market. And currently, the MPC is meeting, though expectations are that they are likely to maintain status quo, irrespective of the decline in inflation that we saw. So we do not expect this to have a significant impact on the market. But I imagine that
I imagine that the MPC would also take into consideration what's happening globally, the uncertainties, the tariff, and how unnerved and unsettled some investors are. We have seen some capital flight, since all of that started. Is the market expecting comment around that?
Well, you're correct. The fact that inflation declined in April is not sufficient for the committee to take a bold decision. There's still a number of uncertainties in the global market, and even the domestic economy, there are still upside risk to inflation. Q2 is the peak of the planting season, and what we usually see is that they usually reduce supply and increase the prices, though consumers are also price resistant at this point in time because of the weak purchasing power. So all these factors will be put into consideration. Then apart from the fact that the committee are saddled with ensuring that there is price stability, exchange rate stability is also a major consideration. Considering the fact that recently there has been a development that we've started seeing oil marketers, importing fuel. So this will definitely increase FX demand, which will put pressure on the currency, in addition to what is happening in the global space. Although I think last week there has been like some calm in the space when you look at the tariff between the US and China, right, because they've agreed to a 90-day suspension window. So while this will ease the level of concern, it might not be enough to help stabilize the currency. So it will also be a major consideration, and that is why we are expecting that the MPC will most likely maintain and keep watching this new development and see how they're going to impact both the macro space and the global space before taking any other decision.
I mean, I thought it took that long break to have enough time, to ponder and come up with something. And well, I guess we'll find out tomorrow. Now, for the Q1 earnings, they were quite good, and they said a lot about the companies, how resilient they were, how perhaps also innovative they were, and also something about the business environment, and perhaps also tying that to the strength of the reform. So if we've seen those strong Q1 numbers, what can we expect in terms of the business environment that these companies are going to be operating in? We know that, yes, we've seen some stability around the exchange rate, but there's still pressure.
Exactly.
There's still also, global uncertainties and all of that. The consumer wallet is still under pressure, even though we've seen inflation, food inflation come down. So these factors are still there, that were there in 2024. That being said, can we still expect these kinds of numbers in Q2 from these companies?
Well, kudos to the players in the FMCGs, because a number of them have been able to come out of the wood. We've seen some of them even record FX gains compared to the losses that were recorded in 2024. And for those that still have FX losses that has reduced significantly. So in Q2, we expect this positive trend to be sustained. The rate of change might not be as much as what we saw in Q1, but because the Naira has been relatively stable, we didn't see that sharp decline that we saw in 2024. So since the Naira has been relatively stable, it will support their performance in Q2, just that it might not be as significant as we saw in Q1. And moreover, like you mentioned, consumers are still battling with squeezed income. So the level of growth in consumer spending also might be reduced, even as though the federal government has increased the minimum wage last year, but a number of states are still yet to start implementing. In fact, some have not even started implementing the 30,000 naira minimum wage, talk less of the 17,000. So we still see that weakness in terms of consumer demand, so which will impact them. But by and large, we still expect that the positive trend in performance will be maintained, just that it might not be as significant as we saw in Q1.
And for the industrials, can we expect a strong performance also? We know we have a big budget, but I mean, some analysts are telling us that, look, with revenue projections falling below expectations, there might be some room to tinker with the budget and all of that. But where does that leave the cement makers, for instance? Yeah,
so for cement makers, well, though the positive performance might be sustained, it might not be significant in the sense that the government is battling with reduced revenue at this point in time. So the level of government spending or government construction or infrastructure activities will be reduced. And also for consumers, a lot of consumers are battling with squeezed income. So we have necessities before going to projects and all. So we're likely to see that positive performance, but it's likely to be mild and not that significant in Q2. And also know that we are gradually approaching the rainy season, where we generally see slowdown in construction activities, and that will also reflect in reduced demand for their products. So by and large, while we don't expect them to run at a loss, the performance might not be that impressive like we saw in Q1.
Olufunmilola, I must thank you for your time. Thank you so much for sharing the highlights of the market with us. We appreciate your time today. That was Olufunmilola Adebowale, Head of Research at Parthian Partners.